Welcome back to the Deep Dive.
Great to be here.
Today we're jumping into a really interesting, often dramatic sector, energy.
Absolutely. Lots of ups and downs there.
Exactly. And we're trying to solve a puzzle, really. How do you find income streams, high-yield ones that also grow consistently?
Especially when the underlying commodities, oil and gas, are just so volatile, it's a tough combination to find.
Right. Our sources, though, they point towards something they call structural resilience. We're looking at two big names today, ExxonMobil, that's XOM, and Enterprise Products Partners, EPD.
Two giants in their respective fields.
Yeah. So the mission today is really to figure out the mechanics, the business models that let these companies ride out the storms.
Not just survive, but actually keep growing those payouts to shareholders right through the thick of it.
That's the key.
Yeah. And what really jumps out is that combination stability and high yield. It's pretty rare.
Usually you get one or the other, maybe.
Right. High yield often signals risk, or maybe growth is stalled out. So when our research flags companies that nail all three good yield now, a history of growing that payout, and the financial strength to keep it going, well, you really have to stop and ask how.
How do they build that resilience?
Exactly. How is it baked into their structure?
Okay, let's start unpacking that. The first thing to maybe acknowledge is this contradiction, right? The energy sector swings wildly with commodity prices.
Definitely.
But our sources also call it a strong source of high-quality dividend stocks. Seems counterintuitive.
It does on the surface, yeah. But we're talking about a very specific kind of elite group within the sector.
Not just any energy company.
No, absolutely not. We're talking about durability. Real dividend champions in a tough, cyclical industry.
So the track record is crucial.
It's everything. And, the sources pointed out something interesting about timing, too.
Oh, yeah.
They mentioned that historically, opportunities to buy these reliable income growers often pop up when the market's feeling a bit nervous.
Like now, maybe? Or around this time of year, October was mentioned.
Potentially, yeah. That was suggested as maybe a favorable time for people really focused on finding that reliable growing income. It's about being selective.
Okay, that leads us perfectly into our first case study in durability, ExxonMobil.xom.
A super major.
A classic example.
Just the headline numbers are pretty striking. Current dividend yield, what is it, around 3.5%?
That's right, 3.50%. Which, for context, that's nearly 3 times what the overall S&P 500 index pays out, less than 1.2% there.
A significant difference. But, like you said earlier, the yield is only part of the story.
Right. It's the longevity that's really impressive here.
It really is almost unparalleled in the sector. We're talking 42 consecutive years of raising the dividend. 42
years. Just think about the chaos that streak has survived.
Exactly. Oil crashes in the 80s, the Asian crisis, the global financial crisis back in 08, 09.
The pandemic shock just a few years ago.
Right. To navigate all that and still increase the payout every single year, that's remarkable.
It puts them in rare company.
Very rare. Only about, 4% of S&P 500 companies can claim that kind of record. And they lead the energy sector in that consistency.
Okay. Phenomenal resilience. But let's get into the how. You mentioned that earlier. When oil prices tank, their main product's value is falling. How do they keep finding the cash to hike the dividend? What's the mechanism?
Okay, this is where digging into their integrated model really shows its value.
Integrated meaning?
Meaning they operate across the whole chain.
Yeah.
Upstream finding and producing oil and gas, midstream the pipelines and transport, and downstream refining oil into gasoline, jet fuel, and making chemicals.
Got it.
And that integration, that scale, provides a really crucial built-in hedge against those price swings. It's counter-cyclical.
How does that work? If oil price drops, doesn't everything suffer?
Well, the upstream part, the production side, definitely suffers. Revenues fall hard there.
Right.
But think about the downstream, the refining and chemical businesses. For them, crude oil is a major cost.
Oh, okay.
Yeah.
So cheaper oil is good for them.
Often, yes. When oil prices drop, their input costs go down. This can actually cause their profit margins, the refining margins, to widen.
I see.
So the downstream part starts making more money, sometimes substantially more, which helps offset some of the losses from the upstream side.
So they're not just diversified in different businesses, the businesses actually hedge each other.
Precisely. It's designed that way. It smooths out the earnings volatility that comes with commodity prices.
Okay, so that's the operational hedge. What about the money side, the finances? How do they avoid having to slash payouts or take on scary debt levels during those long slumps?
Yeah, that's the other pillar. The research calls it a financial fortress.
Sounds impressive.
And it's not just talk. It's backed by real numbers. Our sources highlight that XOM has kept its debt levels, say debt to equity, much lower than most of its peers for, well, decades.
The strong balance sheet.
One of the strongest globally. And that translates into enormous financial flexibility. They have top-tier credit ratings.
Meaning they can borrow cheaply if needed.
Exactly.
Yeah.
Even when times are tough in the energy market, they can access capital at attractive rates. And they use that strategically.
How so?
They can use that borrowing capacity not just to survive, but to continue funding their big long-term growth projects and maintain that commitment to shareholder payouts. That ability to essentially fund through the cycle is a huge advantage.
It separates them from companies that have to pull back hard when prices fall.
Absolutely. That capacity to weather the storm, sometimes for years, is what makes that dividend record possible.
Okay, that covers the past 42 years of resilience. But what about the future? To keep this streak going, they need growth, right?
Yeah.
Serious cash flow growth.
Definitely. You can't just rely on cost-cutting forever.
And the research points to some massive investment plans out to 2030.
It's a staggering number, actually. They're talking about investing $140 billion through 2030.
Wow. Billion with a B.
Yes, $140 billion on major capital projects. And this isn't just, replacing old equipment.
What's the focus?
It's focused on really long life, high return assets. Things like their huge developments in the Permian Basin in the U.S., major new oil and gas production coming online in Guyana, expanding the refining and chemical plants. And also, interestingly, making significant investments in lower carbon ventures. They specifically mentioned lithium production.
$140 billion. That's a huge commitment. It sounds ambitious, but, big capital projects can sometimes go wrong. Cost overruns, delays.
That's always a risk, absolutely.
Or maybe they're banking on oil prices staying high, and what if they don't? Does the analysis address that risk?
That's a fair question, and yeah, the sources suggest the risk profile here is maybe better than average. Because these aren't just random projects. They're targeting large-scale, structurally low-cost resources. Like those Guyana fields, they're designed to be profitable even if oil prices fall quite a bit.
So less dependent on high prices.
That's the idea. And the conviction behind this plan is pretty strong. The projection is that these investments will boost earnings by around $20 billion a year and cash flow by $30 billion a year by 2030.
That's a massive uplift.
It is. And it's that projected growth that gives the market confidence, give them confidence that they can fund the next wave of dividend increases.
Okay, that's a really clear picture of ExxonMobil's integrated approach. Now let's switch gears a bit.
Sure.
We're moving from the supermajor model to enterprise products partners, EPD. Still energy, but a different part of the business.
Right, the midstream sector. Think pipelines, storage, processing.
The toll road analogy is often used here.
Exactly. EPD applies that integration idea, but to infrastructure.
And the payout story is just as compelling, maybe even more so in some ways. A very high yield, currently around 7%.
A very attractive yield, yeah.
And the consistency is right up there, too. 27 straight years of increasing their distribution.
Another impressive streak, just behind XOM's.
Now, before we go further, you flagged something important earlier about EPD's structure.
Yes. Absolutely critical. We need to pause here for a moment.
Okay.
EPD is structured as a master limited partnership, an MLP. That's different from a regular corporation like ExxonMobil.
And that means different tax forms, right? You mentioned a K-1.
Exactly. Instead of getting the standard form 1099 DIV for dividends, investors in EPD receive a Schedule K-1.
Okay, why does that matter? Is it complicated?
It can be, yeah. We can't just gloss over this.
Yeah.
A K-1 means your tax filing gets more complex.
How?
Well, you might have income allocated across different states, requiring multiple state tax filings. You also need to track your cost basis differently because of how distributions are treated.
Distributions, not dividends.
Right. Technically, they pay distributions. And here's a key point. Those distributions generally aren't taxed at the lower qualified dividend rates.
Ah, okay. So potentially higher tax drag.
Potentially, yes, on an annual basis. However, there's a flip side, which is why income investors are often drawn to MLPs.
Okay.
A large portion of the distribution is often classified as a return of capital. This is due to depreciation allowances passed through to the unit holders.
Return of capital, meaning you don't pay tax on it right away.
Correct. It reduces your cost basis in the investment, effectively deferring the tax liability until you eventually sell your units.
I see. So it's a trade-off. More complex tax filings now, but potentially significant tax deferral over the long term.
Exactly. You absolutely have to understand that trade-off if you're considering an MLP like EPD. It's not for everyone, purely from a tax perspective.
That's a really important clarification. Thanks. Okay, let's get back to the reliability of that big 7% payout.
Sure.
What makes EPD's cash flow so steady and predictable, especially compared to, say, an oil producer whose income swings wildly with prices?
It comes down to their business model, that toll road concept. They own a massive integrated network of assets, pipelines, processing plants, storage terminals, export facilities.
The physical infrastructure that moves energy around.
Precisely. And they get paid for using that infrastructure.
Not necessarily based on the price of the commodity itself.
Largely not. Their cash flow is primarily generated from fees charged for the volume of product natural gas liquids, crude oil, refined products that flows through their system.
Okay.
And critically, these fees are often set by long-term contracts, sometimes lasting many years, or they're based on rate structures regulated by government agencies like FERC.
So it's fee-based, volume-driven, and contract-backed. That sounds much more stable.
It is inherently more stable than being exposed directly to commodity price fluctuations.
But what about volume risk? If there's a big downturn and less oil or gas is being produced or consumed, do their volumes drop off a cliff?
That's where another layer of defense comes in, related to those contracts.
Okay.
A significant chunk of their contracts, especially with their larger customers, includes what are called minimum volume commitments, or MVCs.
Minimum volume commitments, meaning?
Meaning the customer has to pay EPD a certain minimum fee, whether they actually ship that much volume through the system or not.
Ah, like a take-or-pay clause.
Essentially, yes. That provides a really strong contractual floor under their revenues, even if physical volumes dip temporarily. It adds another layer of certainty.
And we see the results of that stability in their coverage ratio.
We do. The sources noted that EPD covered its distribution payout by a comfortable 1.6 times in the last reported quarter.
So plenty of cash flow cushion.
A very healthy cushion. And just like Exxon, EPD boasts exceptional financial strength. The research highlights them as having the strongest balance sheet in the entire midstream sector.
Another financial fortress element supporting that high yield.
Exactly. Low debt, lots of flexibility.
Okay, so stability is clearly there. But again, income investors usually want some growth too, right? To keep pace with inflation, if nothing else.
Absolutely. A flat payout loses purchasing power over time.
So is EPD just kind of running the existing pipes, or are they expanding?
Oh, they are definitely expanding. There's a very visible wave of growth happening right now.
Near-term stuff.
Yes, very near term. They currently have about $6 billion worth of growth projects under construction.
$6 billion, also a big number.
It is. And the key thing for investors looking for visibility is that all of these projects are expected to start commercial operations by the end of next year.
Wow, so that cash flow impact is coming very soon.
Very soon. That provides a clear line of sight to a significant bump in earnings and cash flow, which should directly support further increases in the distribution.
Is that growth all from building new things, organic growth, or are they buying assets too?
It's both. That strong balance sheet gives them the firepower for acquisitions as well.
Any recent examples?
Yeah, the sources mentioned a deal just recently. They bought a natural gas gathering system from Occidental Petroleum for about $580 million.
Okay.
But what's interesting is it wasn't just buying existing pipes. The deal also included funding the construction of a new gas processing plant tied to that system.
Ah, so growth built into the acquisition.
Exactly. And that new plant is expected to come online later this year, so it starts contributing cash flow pretty quickly. It shows they're actively looking for growth opportunities, both building and buying.
Okay, so let's pull this together now. We've looked at XOM, the integrated supermajor, and EPD, the midstream infrastructure giant.
Two different models, same sector.
Right. How should someone listening synthesize this? What's the common thread for someone seeking reliable income?
I think the synthesis really highlights the power of, let's call it, structural defense against volatility.
Okay.
Even though they operate differently, Exxon with its full value chain integration and that downstream hedge, EPD with its infrastructure focus and its contractual hedges, they share some core strengths.
Which are?
Both companies back up those high-growing payouts with rock-solid balance sheets. Immense financial strength.
Right, the financial fortress aspect.
Exactly. And both have highly diversified business models designed specifically to minimize their direct exposure to day-to-day swings in oil and gas prices.
One through operations, the other through contracts.
Precisely. And maybe most importantly, for income seekers looking ahead.
Yes.
Both have very clear, well-articulated pathways for future growth.
We saw that with ExxonMobil's $140 billion plan out to 2030.
And EPD's $6 billion in projects coming online basically next year.
Right.
That forward visibility gives confidence that these aren't just companies resting on their laurels. There's a roadmap for potentially lots more growth ahead, which is what you need to sustain those dividend and distribution increases.
Yeah, that's really where this gets interesting for you, the listener, I think. These deep dives really show how stability can be engineered, even in a sector known for being unstable.
It's not about avoiding the sector, it's about finding the right structures within it.
Exactly. XOM uses that operational diversification, the refining cash flow acting as a buffer. EPD uses those contractual defenses, the long-term deals, the minimum volume commitments to lock in its cash flow.
Two different strategies, same outcome. More predictable results.
It's just a fantastic illustration of how smart business design can really mitigate that market risk. Our sources clearly point to these specific resilience factors as the reason XOM and EPD stand out for reliable, growing income.
Yeah, and maybe if we broaden the lens a bit for you, the listener, thinking about reliable income beyond just energy.
Okay.
This whole discussion raises a pretty interesting question to chew on, right?
Which is?
Well, if these highly integrated models or these heavily contract-backed cash flows are the best defense against volatility here, what other sectors outside of energy might have similar structural defenses built in?
Looking for the same types of business models elsewhere.
Exactly. Think about, say, regulated utilities with their set service areas and rates, or maybe infrastructure funds owning assets with long-term leases.
Or even certain software companies with really sticky long-term subscription revenues.
Potentially, yeah. The homework for you, maybe, is to look for those business models, regardless of sector, that are inherently insulated from wild swings in price or demand because of regulation or contracts or just deep integration.
That's a great final thought. Look beyond the industry label. Focus on the underlying business mechanics.
That's where you often find that durable income.
Excellent. Well, thank you for joining us for the deep dive.
My pleasure.
We'll catch you next time.